Hello, my name is Jehan, and today I'm going to be talking about the effect of monetary policies on trade. The first thing is, what are monetary policies? Monetary policies are policies used by the authority of a country in order to govern the economy or the flow of money in the country. The chief financial authority is generally the central bank. Now, these policies affect all kinds of financial and economic decisions taken by people in the country. Now we'll talk about how these policies actually affect trade. Now, monetary policies affect the money supply, which in turn affects the rate of interest and inflation, both of which are major factors which affect trade. Now, monetary supply is enacted by the banks by manipulating the money supply in the economy. The money supply influences the rate of interest and inflation, both of which are, like I said, major factors affecting employment and trade. Now, expansive monetary policies involve the central bank either buying treasury notes or decreasing the rate of interest on loans, or reducing the reserve requirements. All of these actions increase the money supply and lead to lower rates of interest. This creates an incentive for the banks to loan money and also for businesses to borrow money from the banks. As a result of this, businesses and people in general end up spending and investing more, and this in turn increases the demand and flow of money. Now, these expansive monetary policies also make consumption and spending of money more attractive compared to savings because of the low rates of interest. Uh, Due to this leads inflation increases, and due to this inflation, products become cheaper, and hence it is easier to export goods and for consumers to buy goods. Now, on the other hand, contrary monetary policies are enacted to stop inflation rates. Sometimes inflation rates get too high, and the bank has to control these. So these monetary policies can also be used to control the expansion rates and inflation. It tightens the money supply and discourages businesses from borrowing money from the bank and spending money like they would under expansive monetary policies. It helps control trade and impacts exports and increases imports, and this results to a decrease in the aggregate demand. So, to conclude, I'd like to say that the trade sector is firstly extremely important to the economy of any country, and monetary policies, depending on how they are implemented, whether expansive or to control, can either increase the demand and trade, or if needed, can also be used to control inflation and the trade. Thank you.